Thomas, good to see you. Today, we're going to talk about the 5 planning mistakes that you really need to avoid. According to bankrate.com, nearly 3/4 of US adults have at least one financial regret. So, today we're breaking down the top 5 planning mistakes. I know you've seen a lot. So, number one is not having a GRIP on your retirement. GRIP is an acronym for Guaranteed Retirement Income Plan.
Absolutely right. Get a grip, right?
Yep.
No, but you need to think about this. This is pretty important because when you think about 30 years or 25 years in retirement, putting yourself in a position where you can have guaranteed income through pensions, through annuities, and obviously Social Security can definitely be something that can mitigate a lot of your potential expenses later
Mhm.
in life.
Mistake number two, taking inappropriate risk. Taking on too much or even too little can derail your retirement. But how do we know how much risk we should be taking?
Well, it depends on where you're at in retirement, and then obviously or how close you are to retirement. And if you're in retirement, you don't want to put yourself in a position where you're going to maybe gain 5% in growth in your portfolio, but run the risk of losing 20 to 30%. So just to be able to reevaluate that, so that you're not putting yourself at risk. And then obviously, if your portfolio is not growing aggressively enough pre-retirement, then you may want to recalibrate that and look at increasing the risk to get some growth. Mhm.
And mistake number three is a gross planning mistake, focusing too much on your gross savings, i.e., saving too much in those tax deferred accounts.
Right. Well, depending on what that tax deferred account is, right? Like traditional IRAs or your qualified accounts, 401ks, you got to think about taxes. When you go to do the distributions, that's the catch, right? When you go to pull that money out, you're going to be potentially in a higher tax bracket, or you're going to have to pay taxes on that money that comes out. So,
Mhm.
mm,
All right, mistake number four is not having a plan for long term care, which 7 out of 10 people will need at some point.
right. And this is massive because this can be a major impact to your assets down the line when you're in those 70s and those twilight years when you're starting to have to pull money out to pay for long-term
Mhm.
care if there's nothing in place. So not having that in play can definitely hurt you.
And our last mistake is not optimizing Social Security. Only 4% of people claim at the most financially optimal time. The remaining 96% are missing out on what comes out to $111,000 per household.
This is huge. We
Yeah.
need to get together to think about that, right? We need to put a plan together on the Social Security side because when you're 65 or you're 67, when you're full retirement age, if you claim too early, you're going to lose, a portion of that money. And then obviously, if you don't need it, you can allow it to grow for several years until age 70 at an 8% rate to increase your revenue later in life. So this is important to think about.
Well, if somebody wants to create a financial plan that, addresses all of these risks and common mistakes, what's the best way to reach you, Thomas?
Right. Go to my website, martinheritagegroupllc.com. You can schedule some time. You can also give me a call, 651-503-6064. And then you can shoot me an email at info@martinheritagegroupllc.com. And then I'm also on all social media platforms at Martin Heritage Group.
Great. Thomas, thank you.
Thank you.